You probably know about IRAs. Maybe you've heard of solo 401ks. But there are retirement accounts most freelancers have never heard of that could save you thousands in taxes and help you retire the years earlier. In the next 8 minutes, I'm going to reveal 5 retirement accounts that most self-employed people don't know about, including one that gives you triple tax advantages and another with no contribution limits at all. Note: this information applies to US-based freelancers and self-employed individuals. Welcome to the Freelancers Wealth Blueprint, where we turn complex financial concepts into clear action steps for freelancers and gig workers. If that sounds helpful, hit subscribe. We drop new videos every week. Let's get into these hidden retirement accounts. Account number 1, the Health Savings Account, or HSA. Most people think of an HSA as a medical expense account, but it might be the most powerful retirement account available to anyone, including freelancers. Here's why. The HSA is triple tax advantaged. Your contributions go in tax-free. The money grows tax-free. And when you withdraw it for qualified medical expenses, that's tax-free too. No other account offers all three. In 2026, you can contribute $4,400 for individual coverage or $8,750 for family coverage. If you're 55 or older, add another $1,000. Here's the retirement strategy most people miss. You don't have to use your HSA funds right away. You can pay medical expenses out of pocket now, save your receipts, and let your HSA grow for decades. Then in retirement, you can reimburse yourself tax-free for all those old medical expenses. And after age 65, you can withdraw HSA funds for any purpose, not just medical. You'll pay regular income tax on non-medical withdrawals, just like a traditional IRA, but there's no penalty. Unlike traditional retirement accounts, HSAs have no required minimum distributions. Your money can grow tax-free for as long as you want. The catch? You need a high-deductible health plan to qualify. For 2026, that means a deductible of at least $1,650 for individual coverage or $3,300 for family coverage. Many marketplace plans qualify. Account number 2, the spousal IRA. If you're married and your spouse doesn't work or earns very little, you might think they can't contribute to an IRA. Wrong. A spousal IRA lets a working spouse contribute to an IRA on behalf of a non-working spouse. As long as you file jointly and have enough earned income to cover both contributions. Each spouse can contribute the full $7,500 in 2026 or $8,600 if they're 50 or older. That's up to $7,200 per year in additional retirement savings that many couples don't realize they can make. This is huge for freelance households where one spouse handles client work and the other manages the home or works part-time. You can effectively double your IRA contributions. Account number 3, the backdoor Roth IRA. If you earn too much to contribute directly to a Roth IRA, you might think you're locked out of tax-free retirement growth. But there's a legal workaround called the backdoor Roth. In 2026, you can't contribute directly to a Roth IRA if you're single earning over $168,000 or married, filing jointly earning over $252,000. But there's no income limit for contributing to a traditional IRA and then converting it to a Roth. Here's how it works. Contribute $7,500 to a traditional IRA. Don't take a deduction. Then convert that money to a Roth IRA. Since you didn't deduct the contribution, you only pay tax on any earnings, which will be minimal if you convert quickly. Now that money grows tax-free forever and comes out tax-free in retirement. One warning: if you have other traditional IRA money, including SEP or simple IRA funds, the pro rata rule applies. All your IRA assets are treated as one pot for tax purposes, which can make conversions partially taxable. Talk to a tax professional before attempting this. Account number 4, the simple IRA. You've probably heard of SEP IRAs and solo 401ks. But the simple IRA is often overlooked, even though it can be a great fit for certain freelancers. SIMPLE stands for Savings Incentive. Match Plan for Employees. It's designed for small businesses, but sole proprietors can use it too. In 2026, you can contribute up to $17,000 as the employee, plus a mandatory employer match. The total potential contribution is lower than a solo 401k, but the simple IRA has some advantages. First, it's simpler to administer. No annual filing requirements. Second, if you plan to hire employees in the future, a simple IRA scales easily. Third, contribution limits are higher than a regular IRA. The simple IRA works best for freelancers who want simplicity and plan to eventually hire help. Account number 5, the defined benefit plan. This is the big one that almost nobody talks about. A defined benefit plan is essentially a pension you create for yourself. And unlike other retirement accounts, there are no fixed contribution limits. Your contributions are based on actuarial calculations designed to provide a specific retirement income. For high-earning freelancers in their 50s or 60s, this can mean contributing $200,000 or more per year, all tax-deductible. Let me repeat that. If you're earning high six figures and want to shelter massive amounts from taxes, a defined benefit plan lets you contribute far more than any 401k or IRA. The catch? These plans are complex and expensive to administer. You'll need to hire an actuary, and there are ongoing compliance requirements. Setup costs can run $1,000 to $3,000, with annual administration fees of $1,500 to $2,500. Defined benefit plans make sense if you consistently earn over $300,000 and want to aggressively reduce your tax burden while building a substantial retirement fund quickly. Here's how to stack these accounts strategically. Start with the basics. Max out your solo 401k or SEP IRA first. These give you the highest contribution limits for most income levels. Add an HSA if you qualify. The triple tax advantage is unbeatable, and you can use it alongside any other retirement account. Consider a spousal IRA if you're married with a non-working spouse. It's free extra contribution room. Use the backdoor Roth if your income is too high for direct Roth contributions. Tax-free growth is worth the extra steps. Explore a defined benefit plan only if you're earning consistently high income and want to shelter more than a solo 401k allows. The beautiful thing is, these accounts aren't mutually exclusive. A high-earning freelancer could potentially contribute to a solo 401k, HSA, spousal IRA, backdoor Roth, and defined benefit plan all in the same year. One final note. Retirement account rules are complex and change frequently. The strategies I've shared are general education, not advice for your specific situation. Work with a qualified CPA or financial advisor to optimize your retirement savings. That's the breakdown on retirement accounts you probably didn't know about. If you found this helpful, hit subscribe for more freelance finance content. See you in the next one.